This is Taking Stock on Bloomberg. I'm Pim Fox. Conservative investors, listen up. Charles Lieberman of Advisors Capital Management. He has built a portfolio just for you, the investor who is perhaps more concerned with producing income than worrying right now about growth. Chuck Lieberman, good to have you with us. Thanks for coming in.
Thanks, Pim.
Now, the last time you were here, one of the things that you focused on that got a lot of attention was this whole idea of, okay, there's a lot of individuals, a lot of investors, they need income. They need to live. So you've put together sort of an asset allocation model that really will sort of purport to satisfy that need. Tell us a little bit about that.
Well, it's called Income with Growth. The primary objective is income. We want to maximize income production for the client. And we also want to produce some growth, because if you don't produce growth, if you use only fixed income to produce income, then that income erodes by the rate of inflation. And usually that isn't very rapid, but still, even a 3% inflation cuts 25% of a purchasing power in 10 years. So that's devastating. If you are 65 and you retire and you plan out for your life expectancy, which is roughly 20 years, you could have your income fall by almost 50% while in retirement, which is devastating. And very few people have enough capital to be able to absorb that. So it's critical to invest in securities that will produce a gradually rising stream of income that will at least keep up with inflation.
All right, well, let's talk about the different asset classes, so to speak, inside this asset allocation model. Let's start, for example, I know that you've been focused on master limited partnerships. What percentage of a portfolio might you suggest there?
Well, we would start with, let's say, 20%, and everything we do is in separate accounts. So we tailor it to the client. Some clients need more income, some want a little bit more growth, some have portfolios that are large enough that they don't need all of the income that their portfolio is capable of producing. But let's start with a 20% allocation to MLPs. These are oil and gas pipelines, so they represent tangible assets. So inflation is actually something that benefits those firms. They become more profitable with inflation. In fact, to them, the more inflation, the better. Their income will grow more quickly, and that means that their dividend payments, which are called distributions, they're not formally dividends because these are mostly limited partnerships, in fact, will grow over time.
What are the tax implications of those distributions from master limited partnerships, since they're not just dividends, let's say, from stocks?
Right. Well, they're a little complicated because they provide K-1s instead of 1099s, which is a royal pain in the neck, so you really need an accountant to help you with this. But the beauty of them is a lot of the distribution is treated as a return of capital, and it reduces the cost basis of the investment and is not necessarily taxable. For the typical LP, you're looking at, let's say, 80% to 90% of the payment of the quarterly dividend as a return as lowering the cost basis.
All right, so in the world of master limited partnerships, one of them, Energy Transfer Partners, I believe, is one of the ones you want to focus on. Magellan Midstream is another, and also Mark West Energy Partners. Why so focused on just, these are mainly all pipeline companies?
That's right. Mostly we like the pipeline companies because they function like transportation systems. They don't take commodity risk, so it doesn't matter particularly to them whether the price of oil is $100 a barrel or $70 a barrel. They're making their money by transporting oil and oil products. Mark West is a gas gatherer, so it has more commodity exposure. The yield is therefore higher, and there is a bit more risk. So we try to blend a mixture of these things to spread the risk around, have different kind of exposure in the marketplace.
All right, so the other two, Magellan Midstream as well as Energy Transfer Partners. When you talk about them as being energy systems and try to sort of blend the risk, that seems to be the focus here, right, is not concentrate too much in one area, even in one MLP.
Exactly right. We want, even within MLPs, we'll have several per portfolio. We want to diversify the risk. In the case of Mark West, we like its exposure to the shale gas plays, which we think will grow over time. That's very good because it'll fill up their pipeline.
What about the next portion of the asset allocation model? I know you want to talk about real estate investment trust. Is that kind of a contrary play, I mean, given what we know about real estate, or is this just buying them on the cheap?
Well, it's some of both, actually. They used to be considered very low-risk investments. The beta of these stocks typically were in the range of, let's say, 0.5 to 0.6.
Beta for that meaning the fluctuation from the S&P 500?
That's right, and therefore half as volatile as the typical stock in the exchange. So relatively less volatile stocks A lot of the return coming from the dividend. These are relatively boring companies. They own a shopping center. They own an office building. They lease them out. The leases turn over once every 5 to 10 to 15 years. So they're not exciting companies, which is wonderful. You just clip your coupon, so to speak. You let the rents roll in, and they pay out 90% of their profits as required by law as dividends. Very safe investments. In the last year and a half, they were not safe because they have a lot of debt on their balance sheet. Like all real estate players, they have mortgages. Mortgages were a four-letter word in the past year, year and a half. But as the credit markets are recovering, these things are beginning to take off once again. And they're much more easily able to get financing. Conditions continue to improve. I anticipate a lot more improvement as the economy recovers, as I expect it to. Then the rents will be that much more. We'll have that much more confidence that the rents will come in, and again, the yields are very attractive.
Let's talk just about a couple of them. I know that you are looking at medical properties trust, and then there's also a senior health properties. Is that a particular area because of a demographic issue?
Well, there's a demographic play, and there's also a safety play. Within the universe of real estate investment trusts, there are some that are much more exposed to current market conditions, like hotels, where the term of the lease is effectively overnight. And then there are others where the term of the lease is much longer. Medical properties and healthcare REITs in general, basically these are longer-term plays. They're a little bit immune from the market because obviously when people are in nursing homes, they need those kind of facilities for the balance of their life. So it's a relatively safer play, and that's one of the attractions of them.
All right, we're going to continue the conversation. We've got more with Chuck Lieberman. We're going to go over the asset allocation muscle, also focus on some preferred shares, where they fit into the whole portfolio. This is Taking Stock on Bloomberg. This is Taking Stock on Bloomberg. I'm Pim Fox. Charles Lieberman is here to talk about income and growth inside one portfolio. Chuck Lieberman, good to have you with us from Advisors Capital. Let's continue the conversation about asset allocation, because I know now there is the really issue of debt. You want to own some debt, I would imagine, in the portfolio. How much?
That's right. And we want to own some debt partly because it has some nice characteristics. It tends to reduce the volatility of a portfolio. Right now, we're on the more aggressive side of the equation because we recognize that the credit markets are coming back, and therefore the best values are to take a little more risk. In fact, the highest quality debt has already appreciated so much it's quite unattractive and, in our view, quite risky, because as interest rates ultimately rise, as they did, for example, today, that will actually take down some of the high-quality parts of the market.
And you're saying actually focus on some exchange-traded funds that are linked to specific, let's say, bond indices, right? I mean, there's that high-yield index that you're looking at.
That's right. For larger clients, we buy individual securities. But for many accounts, for certainly our smaller accounts, we use the ETFs. And then there are a number of them that satisfy our needs. There's one that's HYG. It's an ETF for high-yield debt. The yield is quite attractive. It's about 10%, which is great. And we think that has about 10% or more appreciation in it just to get back to where it was not long ago.
What about the other one? I think there's also a Pimco Opportunity Fund. Is that also something that you wanted to focus on, which is another form of debt?
That's a closed-end fund.
Right.
It's a little bit leveraged. Pimco's a great fixed-income manager. The yield is about 12%. We think there's a little more risk in that one than in the high-yield ETF, but we think it's very attractive, and it probably also has about 10% of appreciation potential in addition to that 12% yield.
What about preferreds? Everyone always wants to know about preferred stocks, and frankly, a lot of people got burned with preferred stocks because they had Fannie Mae, Freddie Mac preferred, and then we heard today CITs not paying on many of their preferreds.
That's right. And the way we played the preferred market some time ago was we shifted a lot of our holdings into the trust preferreds, which effectively own the debt of the company. The trust preferreds held up far better. For example, the Wachovia preferred got hammered, but the Wachovia trust preferred did not. That held up very well. The same thing for the Citigroup preferreds. The yields on these things, again, are in the 8-9% area, and you effectively own a high-quality piece of paper.
What about actual dividend-paying stocks? How much of a portfolio allocation should go to just high dividend or at least dividend-paying stocks?
Well, we want to put at least 20% into that. Again, that gives us a lot more room for diversification because then the world is our oyster. We can look at anything. And we can find good companies, very good companies that have mostly high yields, and those are very attractive ways.
I know that AT&T is one that you mentioned recently.
AT&T is a good example, 6.5% yield. The bonds on the company yield about 6.5%. So if you look at a 10-year AT&T bond at about 6.5%, or the common stock at 6.5%, over 10 years you're going to get some growth in the common, and you're likely to get a dividend increase in 10 years in the common. Obviously more attractive than the bonds.
Give you about 15 seconds. The last category, right, is utilities, because, I mean, these used to be the dividend payers.
They still are. They're boring, but they're nice anchors to windward in a potentially volatile market, so we like some dividends coming from utilities as well.
All right. I want to thank you very much. Chuck Lieberman coming in from Advisors Capital, giving us an insight into that income with growth, growth with income portfolio, and the new asset allocation model. Thank you very much. I appreciate it.